Joining me now, Independent Institute Senior Fellow Judy Shelton. Judy, in the past, most central bankers have said, talk to the hand. We don't listen to the markets. We don't watch the markets. We are looking at the jobs picture, and we are looking at our surveys and economic data. What do you think of him actually flipping this on its side and saying, no, we should get some signals from the stock and bond market?
Liz, I thought it was so refreshing. We're now hearing from a new Fed chairman who believes in the primacy of free market forces to determine the cost of capital. And he's pointing out that we get distortions when good news comes out as bad news because investors aren't responding to the actual price signals in the market. They're more concerned about how the Fed will react to that. So I think it's a real good sign that we have someone who respects the private sector more than a government knows best approach.
The markets can tend to be extraordinarily volatile. Just witness the last couple of weeks where 1 minute we're up 700 points, then we're down 600, the next we're up. So how would that work? And is there any danger in the Fed then constantly shifting what they think should be done for the longer term?
Well, I don't think he meant that there would be an immediate response with every vacillation. And we're seeing that day-to-day events linked to opening up the Strait of Hormuz is causing a lot of that fluctuation. I think what he was saying is that we can learn from free market price signals what the market is saying in terms of all kinds of debt instruments and not try to have the Fed just dictate the interest rate. I think it means the Fed will be watching financial markets as a sign of how restrictive their policies currently are. And he also made a distinction between, for example, the housing market, where he thought the interest rates were restrictive, versus, say, more overnight liquidity that is financing some of the short-term investments.
Even though he had said during his confirmation hearing that he is an independent thinker and that he has not been told by President Trump what to do, even though President Trump has made it very clear to the world that he would love to see interest rates come down, Kevin Warsh came out sounding a little bit hawkish. He said for 5 years now, inflation has been well above the target, and we're going to fix that. People interpreted that.
I think that was a good statement. It was a good, strong statement and very reassuring. But I think that we instantly classify that as being hawkish because we have been trained to think that price stability can only be achieved by curtailing demand and stifling economic growth. And so we think that means that to have stable prices to fight inflation, the Fed has to raise interest rates. What was really interesting, what Kevin Warsh said, was that he does not believe in that cruel trade-off. He thinks you can have low unemployment, high economic growth, and low inflation. So that is really opening up a whole new approach to the way the Fed models how the economy responds to its monetary policy decisions.
But how, Judy, if you're not tightening rates and making it more expensive to borrow, which in turn usually quells demand, people then don't borrow enough to spend more, how else would he be doing it?
Well, this is really why this is such a huge challenge to the intellectual mindset at the Fed. The idea that you can only kill consumer demand to respond to inflation is really based on a Keynesian attitude, the Phillips curve. And what he's saying is something that's more aligned with the supply side approach, which is consistent with what the Trump administration is putting forward. That is, you want to unleash the incentives through lower taxes, less regulation, better energy policy, to get the private sector to increase supply, not to limit demand, but increase output as a better way to fight inflation. So it's really quite revolutionary. And that gives me hope that even though he's saying he wants stable money, which is also part of the supply side approach, he's not committing to the idea that the only way you achieve it is by putting in restrictive high interest rates.
Yeah, although the rest of the Fed, in fact, pretty much look like they all want at least one rate hike this year. 9 of them wanted 2 rate hikes. That said, let me ask you about his his rejiggering of the Fed. He talked a lot about different task forces. He would not give any inch when it came to so many questions about, oh, give us some forward guidance for where interest rates might be. So let's talk about those task forces. He said there would be 5 of them: communications, balance sheet, productivity, jobs, use and reliance of existing data sources, inflation framework. Does that look to you like a great idea, or a little bit more of bureaucracy flowing?
Well, I know it sometimes seems like a cop-out to put together a commission or a task force, but in this case, I think this was a very prudent initiative on his part. And he also said by the end of the year, he thinks he'll be having some results. So this is breaking that mindset in the Fed. This is going to bring in some fresh thinking. I'm particularly interested in the balance sheet task force, because we know that Kevin Warsh wants to cut the Fed's holdings of Treasury securities. He thinks they have too large a footprint in financial markets at $6.7 trillion in their portfolio. But if the Fed is to start selling off or shrinking that portfolio, that's really like QT. It's like quantitative tightening, which means higher interest rates. So I think, and as I wrote in that piece for the Wall Street Journal a couple of weeks ago, he can do both. He can say, look, we want to cut the Fed's presence, which is overbearing in financial markets, and that's going to have a tendency to raise the rate, so we have to lower. Using our other instrument, the federal funds rate, we have to lower specifically the interest on reserve balances to counteract that. And I don't expect there to be rate increases. I actually think that by the end of the year or early in 2027, we could see a rate cut.
I encourage everybody who is saying to themselves, how do you bring down inflation without tightening rates? Judy's written that Wall Street Journal article, and the title is Kevin Warsh Can Tame Inflation Without Higher Interest Rates. So it's a good explainer. I hope everybody checks it out. In the meantime, really quick, Judy, next week we're expecting the Fed's favorite inflation gauge, the Personal Consumption Expenditure Index here, PCE, and the expectation is that it will still come up above 4%. And of course, we saw CPI headline 4.2%. You comfortable with that number?
No, of course not. That's worrying. And I think it's showing this prolonged impact of higher energy prices. We'd like to get this resolved as quickly as possible. But again, let me say, you don't have to raise interest rates if you're trying to increase output and supply instead of curtailing demand. The key is to grant access to capital so those small and medium-sized businesses can hire people and produce more.
Yeah, supply versus demand. And I think I've really started to understand how there are different ways, thanks to you, about making sure that we quell that hot inflation. Judy, good to see you. Thank you so much for joining us today.
Great to be with you, Liz, always.
Okay.
Thank you.